Financial, episode 40. Can you believe it? I've been doing this 40 weeks in a row, and we mark this episode with a very special guest being Jay O'Neill, the CEO of CTA Safe. Now, we've spoken about the CTA previously on this podcast, but honestly, we gave you a lot of good basic information, gave you a bit of insight into what is required, how to do it, and definitely not to ask your attorney or accountant. So what I decided, because I'm starting to get a lot of questions from my clients, is that we need an expert to come in, somebody that actually knows what they're talking about. And I was fortunate enough to bump into a few good people that have developed a great platform to help support small businesses through this, let's say complicated is a good word, confusing, well-intentioned but badly implemented CTA. So Jay, welcome to the show.
Thank you, Zane, for having me. It's a pleasure to be here.
Have I sort of summed up exactly what's going on in the CTA world well enough, or am I sort of over-exaggerating how confusing it actually is?
No, I think that's right. It's an interesting history to the act. It was passed in 2021, which you would think would have given, FinCEN a lot of opportunity to communicate this clearly, to develop the rules, communicate it clearly to the stakeholders, or at least have the stakeholders know who they are and get it implemented. And that simply hasn't happened. There's some fundamental shortfalls in the rollout of this and the underlying assumptions of that rollout that have really proven not to be true. So it's left a lot of people guessing on a lot of aspects of this.
I mean, that is crazy that it came out in 2021, but almost every person I speak to has never heard about it before.
Well, and it was clearly considered that time between its passage and its implementation, because it took effect this year. In January of this year is when it was scheduled to take effect. And it was clearly designed with that lag to allow two things. One is for FinCEN to develop its regulations underneath the statute, and the other was to communicate it. And they've done most of the first one, and right now FinCEN's doing sort of town halls on this. But most of the people I know who own small businesses are completely unaware of those town halls.
Yeah, I mean, when you brought up the town halls, I was like, what? What is that? How do I get involved? What do I see? And, it didn't really make me move a lot quicker either. It didn't make me go out there and chase to try find it, which, this is sort of the thing that I want to know. I want to be able to help people. So for people who are running a small business in this tougher economy with more expensive debt, this is definitely way down on their list. But we have to talk about it. It is important because when we get to it, we will talk about the severe penalties that could be incurred for non-compliance, or worse, for incorrect submissions of data as well, which is even scarier to think about. But can you just give us a quick background on why this was brought in?
Yeah, so the act was originally passed as an anti-money laundering, an anti-narco trafficking, and anti-terrorism act. If you look at the way it's situated in the congressional record, it's right next to reports on Chinese and Russian and other foreign entities' interference in our election process as well. So that's the underlying theory here. There's $300 billion estimated in money laundering that happens in the US every year. And right now, a lot of the financial institutions, people who deal in securities or investments, or larger companies already have some sort of process requirement to report activity that may be tantamount to money laundering. So this is really taking that original anti-money laundering act from the large scale entities down to the small businesses in an attempt to combat that $300 billion in money laundering each year.
Yeah, when I was doing some research before today's discussion, one of the points that stood out to me, and I wrote this down, was the purpose of the act is to increase transparency in financial systems and combat illicit activities like money laundering and fraud. Big words, right? And, I think it's one of those interesting places where I don't think small businesses realize how this would really relate to them. I think most small business people are like, what are you talking about? There's no illicit activities. I'm not money laundering. None of that's happening. But I think we've all watched enough TV shows to know that, it's pretty possible that there are small businesses that are being used as fronts to be able to do this type of business.
Almost certainly, and when we talk about small businesses, let's split it into two categories here, right? One is what we think of as legitimate small businesses, nail salons, boba shops, small law firms, or accounting firms, things like that. But the other is the series of entities, sort of shell corporations that are created to include ownership. So one of the main goals of this act is to create basically a federal registry of small businesses and their owners that different law enforcement agencies can access. And that includes the IRS, that includes other entities, whether they're state tax entities, it actually includes banks as well. They have access to the database. So there's the small business that's sort of, what you drive past on Main Street. And then there are the entities that are registered, but you don't really ever see them anywhere. They serve sort of a more legalistic or tax purpose. And I think that's a big component of what they're trying to crack down on as well. It's very clear when you read the underlying regulations or the development of the regulations that FinCEN, which is the Financial Crime Enforcement Network, which is a division of the Department of Treasury, which is tasked with overseeing this Corporate Transparency Act enforcement. It's very clear that they expect the IRS to use this database to go after tax cheats, because that's where a lot of the money laundering happens.
Yes, if you're thinking about it, it's, especially accountants, bankers, insurance guys, when you get those operating entities, but there's 10 different entities you have to flow through before you actually get to the person who's signing the document. It's trying to sort of figure out and make sure that everybody is aware who owns all those different entities, who the final ownership people are. But let's get into a little bit more of the detail, and let's sort of confirm for everybody who is subject to the CTA.
Yeah, this is a three-part test, and it's really important. So when I say it's a three-part test, that means you have to meet part one, and you have to meet part two, and you have to meet part three. So what's part one? The first is, do you have an entity that's registered with the Secretary of State or the equivalent wherever you live? In California, we call it the Secretary of State. It might be called something different in another state, or on a Native American tribal reservation, or in the outlying areas, territories like the U.S. Virgin Islands. So do you have an entity? What do we mean by entity? Well, that's an LLP, and a limited partnership, a limited liability partnership, an S Corp, a C Corp, or an LLC, a limited liability company, or some combination of those. Different states have different rules for who has to register with the Secretary of State. So your state, you listener, your state may have different rules than California has on this. But in California, we're talking primarily limited partnerships, LLCs, S Corps, C Corps, and some combination thereof. We're not talking general partnerships, and we're not talking sole proprietorship. So if you have that first component, that you're registered with the Secretary of State, we look at the next one, which is, do you have 5 million or less in gross receipts? That means if you look at your last tax return, did it say 5 million or less in gross receipts? Or if you're set up this year, you're going to have to report because we don't have a different number for you at this point. So it's registered as Secretary of State and 5 million or less in gross receipts. What's the third component? Do you have 20 or fewer employees? Right. So, and let's keep in mind that 0 is less than 20. So I talked to a lot of people who say, well, I have this LLC for an investment property. I don't have any employees, so I don't have to report. No, 0 is less than 20, right? So 0 to 20 employees, or 20 or less employees. 0 to 5 million in gross receipts, and you're registered with the Secretary of State. So those are the three components. If those all add together, then you're looking at someone who may be a mandatory reporter under the Corporate Transparency Act. So that's the first step in the analysis. Does that make sense, Zane?
It makes 100% sense, and I think that is a great place to start. And everybody, that's, if you take anything away from this podcast, is go listen to those 3 rules, and make sure, if you are one of them, that you're talking to somebody like Jay.
And thanks, Zane. And there's the next step there is, hey, does an exemption apply? Right. So you may be a mandatory reporting company, but an exemption applies. There are 23 exemptions to the law.
Well,
Most of those exemptions are for people who already have reporting or entities that already have reporting obligations, like banks, securities dealers, investment advisors, and then other places you'd expect, like utilities. are not mandatory reporters. And then for tax exempt entities, there's some limitations on that as well. So if you're not sure, yeah, talk to an advisor to see if you follow. If you think you're a reporting company, talk to your advisor and see if there's an exemption that applies. Most likely not for most people, but it may. And when I say most people, let's just set the record for this year. We're expecting, or FinCEN expects 32.6 million entities to have to file this year, right?
Wow.
So if you're sitting there wondering, do I fall into that? Well, probably, if you meet those criteria, probably. They estimate 32.6 million have to file this year, and then 5 million are expected to file next year and each additional year thereafter as new companies come online.
Yeah, I mean, the way I like to think about it, if you think of yourself as a small business and you're not reporting somewhere else, there's a very good chance you have to report.
Yeah, and one of the things I frequently hear about this is sort of an underlying assumption that, well, this is a compliance obligation. Small businesses don't normally have these kind of compliance obligations. Maybe this doesn't apply because I'm too small. Maybe I set up an LLC on LegalZoom for a dog walking business and I make $15,000 a year. Well, you set up an LLC, you're registered with the Secretary of State, you have less than 5 million in gross receipts, you're the only one who works there, that's 20 or fewer employees. You're a reporter. And just on that employee thing, I want to point out, if you have 21 employees and one employee quits, you're now a reporter, or you fire one. So hire another employee before you fire that 21st employee.
Yeah, it definitely changes the thought process because there's way more things to think about in terms of compliance with small changes in your business. You miss your revenue target and you hit 4.9 million instead of the 5.1 million that you've done in the last 10 years. Also, now you're a reporter.
Yep.
That becomes a lot very complicated. There's a lot of talk about the reporting requirement, what needs to be reported, but there's a lot of talk that the beneficial owner is the person who needs to be reported. And I think that for me is one of the most confusing portions of all of this, because what is that person? What does it look like? What are the requirements to be a beneficial owner? Because, hey, if I've got 1% of that business, aren't I a beneficial owner?
Yeah, that's a good point. So there are a few components that have to be reported here. You have to report information about the company, the beneficial owner, if the company is created this year or later, the company applicant, or company applicants. So let's look at that beneficial owner component. From just the title of it, if I were reading this as a layman, I would think I'd have to have some sort of ownership interest, some equity in the company. Uh, I'd wonder what that threshold is. I get a lot of questions. I own 2 or 3% in a company. Am I a reporter? So the way FinCEN defines, as they created the regulations in the statute, the way this is defined is there are two categories of beneficial owner. One is the beneficial owner who has an ownership interest. This is what I think most of us think of. The other is what's called substantial control. So let's look at that ownership interest component first. So if you own 25% or more of this reporting company, you are a beneficial owner. If you own 24%, you are not a mandatory reporter. You do not have to be reported. And let's talk about who has to do reporting real quick on that too, because it's the reporting company that files the report. So if you own 25% of a company, do you run out and file like you would for your tax return? No, you have to give your information to the company and they file. So 25%, you're a beneficial owner with a 25% ownership interest. What does that look like? Well, let's say I ran down, Secretary of State set up an LLC in California, single member LLC. Well, then I own 100% of the company on its face. I'm a mandatory reporter, right? Okay, so that's pretty straightforward. But there's a little kink in that, and which California is a community property state, right? So if I set up this entity after I was married using community property resources, well, ownership is determined by direct or indirect ownership under the law. And so if I own 100% of that LLC, I'm the one who registered it, but I'm married, I probably have to report my spouse, right? So this is where determining ownership gets a little tricky, right? There's the straightforward, I own 25% or more, great, I'm a mandatory reporter, but maybe community property law is impacting who has to report, right? Maybe there's a convertible note, because when you look at the FinCEN notes on this, they have charts that you can find. that say, okay, well, if somebody has an ownership interest that's prospective, like a future interest, they may be a reporter. So if I have a convertible note that in 6 years' time would convert 25% of the company to me, I have to be reported. If I have an interest in the profit or the capital or an option or a privilege, I may be a mandatory reporter, even if I don't get that interest, the benefit of that interest until later, because they treat it as if you're a present owner. So you're also a beneficial owner. And the same issues come up when we try to evaluate parent-child subsidiary relationships. If an owner owns multiple interests in parent companies that in aggregate add up to 25% of the child company, they're a mandatory reporter. So for a lot of people, this is gonna be pretty straightforward. I own 25% of the company. I don't live in a community property state. I file. That's cool. But I just want people to be aware that there are some traps for the unwary out there as to who that ownership component belongs to.
So what happens in a situation where me and 9 friends get together, we start a company, we all own 10%? Does that mean we just don't have to file at all because nobody has 25% interest?
That would be true as far as the ownership interest component of it. But let's look at substantial control. That's the other part of this test. So who has to be reported under the substantial control test? Well, all of the C-suite officers have to be reported pretty much. There's a list of 6 that FinCEN gives in the FinCEN Small Entity Compliance Guide that you can take a look at. But the senior officers have to be reported. Anyone who has the power to appoint or remove a senior officer has to be reported. Anyone who has the power to appoint or remove a majority of the board of directors has to be reported. Anyone who exercises substantial control over the business in any other way has to be reported. So if I have the power to borrow money for the business, or to decide its product line, or to lease an office, main office for the business, I may fall into this catch-all. So when we go back to you and your friends, Zane, presumably you guys are some combination of you guys are going to be officers in that company and have to be reported under the control portion of it, not necessarily under the ownership portion of that. But if 4 of them sold to a 5th person later, then that report would have to be updated because that 5th person would now have 50% of the company.
How about a situation where I'm the company bookkeeper, but I have signing power on the checkbook? Would that create substantial control and require me to be reported?
So that's an interesting. So this is there is the CFO, and if you're talking about the CFO position within the company, possibly because you have that control. There is an employee exception under the law or under the statute, and you can read more about it within the Small Entity Compliance Guide. There are a few exceptions to reporting requirements. So let's say you were hired as an outsourced CFO, you would have no control. You'd just be doing the work. You don't have to do it. If you actually have substantial control, then you have to file. So check power may qualify as this. And the general rule here is better to over report than under report on this.
I think a big takeaway there is that your title might not be CFO, but if you're doing CFO type things, you might still be in that position by proxy and might be able to, need to be reported. So it does get super complicated.
It does, and you're exactly right. That it's the role you actually do, not the label that's determined as far as FinCEN is concerned. And they're looking
as always,
for flexible
labels are not important.
Yeah, labels aren't important. They're looking for flexible structures where, in essence, someone's keeping control or keeping ownership while using straw men to sort of hide that. So keep in mind, this is a law enforcement database, and they're looking for people who are trying to hide.
Great. Let's jump into reporting deadlines. What do we have to know in this area?
Yeah, this is also a little bit of a mess here. So I'm going to try to break it down into 3 different categories. Okay, first, what happens if your entity was registered before January 1st, 2024? Okay, if you fall into that category, you're a 2023 or earlier entity, you have until January 1st, 2025 to file. They didn't do us a favor with that, right? Because I hear a lot of people say, I have until sometime in 2025 to file. No, you get to ring in the new year with government compliance. So I want all of you to put in your minds, I have until late December to file. But the deadline is January 1st, 2025. Let's say you registered your company this year, January 1st of this year or later, 2024. You have 90 days from the date that your company was registered with the Secretary of State to file your report. So that's 90 days. So there are a lot of companies out there because I think a lot of people were slow on the law. Not only that, FinCEN was slow in releasing access to their database that may have already blown that 90-day statute. Next year, starting on January 1st, 2025, you have 30 days to file a report once you're registered with the Secretary of State. It'll be 30 days thereafter. So what you want to think of is next year and forever thereafter, unless the law changes, 30 days. 90 days for this year and until the end of the year for earlier entities.
So remember 30 days. Forget about the 90, just do 30 days this year, get it done.
And it was originally 30 days this year for this year, but FinCEN, acknowledging the bad rollout that they've done on this, did an extension, a one-time extension of 90 days for this year. So it was originally supposed to be 30 days this year.
Is there any other times when you would have to report, and what are the deadlines around that?
Yeah, that's a good question. So you do have to, let's say you've got your initial compliance filed. The question I get is this an annual report? How often do I have to file this? Well, you have to update it whenever anything with the company changes or whenever anything with the beneficial owners change, right? So if I had a new DBA, I have to file an updated report. And I have to do that within 30 days of the change. That's across the board for all these changes. You have 30 days from the change to file the updated report. So if I had a new DBA or if the company headquarters moves, or if the name changes, we have to file an updated report within 30 days. If the beneficial owner information we're talking about that needs to be reported is name, birth date, address, and government ID, and the ID number. So if you get married and change your name, you have 30 days. If you move, you have 30 days. If your driver's license expires, you have 30 days. And one pro tip I'll share here is for a number of states, the driver's license is good for 4 years before it has to be replaced, but passports are good for 10 years. So you might consider using passport as your ID so that you don't trigger failure to update. So, and that's for any beneficial owner's information changes, a new report has to be filed and updated. So those are things that trigger it. Now, let's say you typed wrong information in. Let's say a secretary was handling this and they typed an old address in, you submitted it, and now you're 50 days out and you realize you made that mistake. Well, there's a safe harbor period for corrections. That's 90 days. So as long as if you try to get compliant but made an honest mistake, you have 90 days to fix it and correct that address, and there will be no fines levied for it.
Okay, let's talk about the scary part. There's some liability involved here if you get this wrong or you fail to file. What's going on in that area?
That's right. So I want to talk about sort of two categories of liability. There's the one that's just in the statute, right? And this breaks down into two categories itself. The first is the civil penalties. The second is the criminal penalties. So there is some confusion over the civil penalties. I see this a lot when I'm looking at advice that lawyers or CPAs or just other third parties are putting out there. What's the per day fine and who is to? Well, when the statute was passed, it said $500. But earlier this year, the inflation adjusted it to $591. So it's $591 per day per individual, not per company, per individual. And so when we're looking at that, we're looking primarily at the C-suite officers. And their governance documents may adjust to handle how they're going to deal with this fine. But you could conceivably have 591 times 5 C-suite officers. And if there's a willfully non-compliant owner with an ownership interest, let's say I own 25% of the company, I refuse to give the company my details for filing, then I'm also subject to $591 per day. So that you have to calculate that as more than just a 1 day 500 or 591 per day. You have to look at the people who'd be subject to the fine and multiply that total times the 591. Now, where the controversy comes into here is there a cap on the potential fine? If you read the statute, as I read the statute, it says no, it's 591 until cured, until fixed. Other people have taken the position that it's 591 with a max of 10,000. I don't think it really matters as far as severity, right? Because if you have 6 people subject to a max fine of $10,000, that's a $60,000 fine for say failure to file. And if you fail to update, that could conceivably be another $60,000 fine if you let it run long enough, or if you fail to correct, right? So this can compound. So that's the civil penalty. You can pick your side as to whether there is an upper limit cap or whether that can get up to hundreds of thousands of dollars. We don't have an example of enforcement yet. But then let's look at the criminal. The way I read the statute, the criminal consequences are a $10,000 fine and 2 years in prison. So that takes care of step one. What does FinCEN do on the enforcement side? The civil fine plus the criminal. But it's clear, as I referenced earlier, that they expect other law enforcement agencies to use this database. So it may be that your failure to report or your incorrectly reported information is access for evaluating whether taxes were properly paid on the entities. And so you may face the IRS fines or whatever other, the Franchise Tax Board in California for the state, other fines from that. So there are the direct fines stated in the statute, and then there are the indirect consequences that you may face for failure to file.
Very expensive, very scary, and it does lead into the big problem that we're all facing right now, is that everybody thought this would be CPAs and attorneys doing the work. They saw the civil and criminal liabilities and said, nope, we're out of here. This is not something we want to touch. So what's going on there? Who can actually help us with these CTA filings and making sure we're compliant?
Yeah, so the interesting thing there is on the CPA front, because I think that's really who FinCEN thought would be doing this. But they failed to do an unauthorized practice of law analysis, something that did not escape Cameco, the largest insurer of CPAs nationwide, who did that analysis and issued an FAQ to CPAs in February saying, hey, here's our analysis of the risks of unauthorized practice of law. And that really falls into the question of who owns the company, who is a beneficial owner, that analysis. Whether you're doing, the parent-child subsidiary, or you're looking at community property law, or you're looking at whether it's in a will or trust, and if there's some sort of estate issue going on there, there's no law authorizing CPAs to do that sort of analysis. And so just in July, New Jersey Supreme Court subcommittee on unauthorized practice law, at the behest of the state accounting society in New Jersey, issued a response to an inquiry on that question, and more or less confirmed what Cameco said, is in all but the most straightforward cases, it's unauthorized practice of law, right? And so CPAs don't want to go without their E&O insurance, their malpractice insurance coverage, and they don't want liability for practicing as a lawyer. So most of the CPAs I meet are refusing to do this. On top of that, it's hard to calendar as a deadline if you have to file a statement of their changes. So CPAs aren't doing it. Business attorneys, my experience with business attorneys is they're getting caught up in the law. A lot of them are getting caught up in the law. I spend a lot of time supporting and training business attorneys on this. So there's a knowledge gap there because they were caught off guard by this regulation as well. And they have trouble with the resources for doing it. So business attorneys, what I'm finding is business attorneys may do the reporting for their existing clients, but they're largely not taking on clients just for this. So where does this leave the state of the market? Well, the law did contemplate third-party service providers, meaning companies that were set up to assist people with getting filed. And so that's where I'm seeing a lot of the filings happening is either people are trying to navigate this themselves on the FinCEN website, or they're going to third-party service providers like my company, CTA Safe.
Well, we're recommending third-party service providers to our clients as the way to go, and CTA Safe is on that list. So why don't you give us a short summary of who you guys are, what you can do, and why you're a great option for small business owners to stay compliant.
Yeah, thank you, Zane. So CTA Safe we are a technology and consulting solution for Corporate Transparency Act filings. That's a mouthful. What does that really mean? Well, first of all, that means we created a cloud-based online software where someone can go in from the company, they can create a company, they can invite the beneficial owners to upload their information and securely e-file it with FinCEN. So we've created a system that allows a quick gathering of information, so you're not spending hours chasing down with phone calls and emails the data that needs to be reported. We're doing it in a secure way to minimize personal information. You can imagine if you're an owner with interest in 10 or 15 different companies, you don't want to email your driver's license, your birth date, your name to secretaries at every single one of these companies. You run the risk of information being misreported or inconsistently reported or having your identity stolen in the process. So we created a secure platform to simplify that. We have strategies also to recommend to people to minimize their ongoing liability or exposure of private information as well. So we're recommending a lot of people get FinCEN IDs as a way of not having to share that information. But we've created a software platform to do that, where you get the filing record, where you can go in and update as needed without having to reinvent the wheel every single time that you do it. So our goal was to take a task that on average was going to take 2.5 to 3 hours to complete down to about 15 minutes on the software side. But we recognize that, it's one thing to fill in a form. Like the form is easy to fill in wrong, but hard to fill in right, as we've discussed in this meeting. So we've created a consulting solution as well, where we can help either on an hourly basis or on a project basis go through your entity, help you figure out who the owners are, help you figure out what additional information you need to file correctly. So it may be there's a prenup or a postnup or a trust or a divorce decree or some other contract that needs to be reviewed by a family law attorney, a state attorney, or a business attorney to get to the right answer. But help you issue spot those matters so that you get the right report filed on time. On top of that, our software also has a monitoring tool in there to help people stay compliant once they are compliant. Because I don't know about you, Zane, but if I weren't doing this, I would have filed once and forgotten about it. And when next time my driver's license expired, my thought would be, do I have an ID to get onto an airplane with, or if I get pulled over for a ticket? Not, how's my compliance stand? So we created a monitoring solution for that as well. So we've got, for people who want to self-serve, we've got, and only need to file once, we've got options for that. For people who expect to file repeatedly, we have options for that. For people who want a little help with their filing, we've got that. And for people who want us just to take over the reins and help them get set up as far as we can and ready to file, we offer that solution as well.
Jay, I appreciate your time. This CTA stuff is confusing, it is complicated, and honestly, it is a little scary. If you get it wrong, there are big penalties in place. So I highly recommend finding a third-party provider that can support you as much as possible, especially through this first filing. You now have less than 4 months. So you're somewhere in the 90 days to 4 month range to get this done. Do not leave it to the last minute. You're not going to be happy if you start getting letters from some scary agencies. You don't want to get anything from Department of Treasury. That's just scary to start with. Talk to people like Jay at CTA Safe. They can definitely help you get compliant, look after your business, look after yourself. And I will talk to you all next week. Have a good week. Be kind. Goodbye.